What will be the costs of the New World Order? Welcome to The Call. I'm Jay Sapsford. Global trade is thriving, for now, but multinational companies are growing wary of geopolitical risk. They are shifting supply chains, cutting dependence on rivals, and sometimes even pulling back from allies. Friendshoring, nearshoring, onshoring, these aren't just buzzwords anymore, they're strategies. And these shifts come with a price, which brings us to today's question. Can the global economy keep growing in a world that's fragmenting? Joining us now is Gita Gopinath, the Gregory and Nania Coffey Professor of Economics at Harvard University, and until recently she was first Deputy Managing Director at the IMF. Gita, welcome to The Call.
Hi, Jay. Pleasure to join you.
Gita, last night you were posting about your assessment of the tariffs that were introduced by the U.S. 6 months ago. I wonder if you might be able to share your overall take on that and where things stand now as this is being rolled out.
Sure. So, yes, it's about 6 months since the Liberation Day tariffs were announced in April, and U.S. average tariff rates have gone up from 2.5% before to now almost 18%. Now, if you look at the actual tariff revenue that's been collected, based on that, the effective tariff looks more like around 10%. So again, if you step back and ask what were the goals of putting these tariffs in place, I would say one was truly to raise revenue for the government. And in that dimension, the tariffs are doing very well. I mean, raised about $30 billion in these last couple of months each. But I think what's important to keep in mind is that is being borne entirely, almost entirely, by U.S. firms, and they're passing some of that on to U.S. consumers. So it doesn't have to be that a tariff works ultimately like a tax on U.S. firms and consumers, but in this case, as it did in 2018-19, it is playing out like a tax on U.S. firms and consumers. The second goal would have been to raise manufacturing, more jobs in manufacturing in the U.S., reduce the trade balance, and neither of that are we seeing any signs of. If anything, there are losses of jobs in manufacturing. And on inflation front, we are seeing inflation show up. It's not a large number, and frankly, I'm not sure why people were expecting it to be a large number. It's in line with what we expected based on the last round of tariffs. So we are seeing some increase, but there are some items like household appliances, furniture, coffee, that have gone up quite substantially. So as a scorecard, it is negative at this point, and we shall see where it goes.
So those inflationary pressures, am I right in interpreting that you're seeing that pretty much as a one-off, or is this something that could lead to inflationary pressures over time as a result of consistently over time as a result of these tariffs?
So firstly, I do think there is some more inflationary pressure, even if the tariffs stay at where they are right now, because we haven't seen more of it being passed through from firms to consumers, and I expect that there will be another round of it. So, inflation right now in terms of core inflation is close to 3%, which is a whole percentage point above the Federal Reserve's target. Whether we stay there or we expect this to be one-off depends crucially on monetary policy. And so here, if it is indeed the case, we move to a regime where we have loose monetary policy and interest rates are being cut pretty dramatically, that's what's going to generate much higher levels of inflation and persistent inflation. I think without that, it's hard to see how you get to very big inflation numbers on a persistent basis.
Gita, let's pull up a chart that captures the U.S.-China rivalry. If the world is splitting into camps, and the numbers that tell a pretty interesting story here, when measured by population, China, its allies, and its friends have a slight advantage, but when measured by GDP, the West still dominates. My question for you, are these the contours of a new Cold War alignment? Do you see that way, or is that too simple a frame?
So I think there are multiple motivations for what we're seeing in the world right now. I would say before the current round of tariffs, it looked very much like this was more of another Cold War in the making, with a Western-centered bloc and a China-centered bloc. But right now, I think there seems to be much more of a protectionist drive. The U.S. putting tariffs both on its neighbors, Mexico and China, and so on. So it's more complicated. If you compare what's happening in terms of fragmentation, and you absolutely see signs of fragmentation in the data in terms of who's trading with whom, you do see that geopolitical factors are playing a bigger role in countries trading with each other. But if you compare it to the Cold War, the amount of fragmentation is still small. But these are early days, and we're still in this phase of firms front-loading their imports, trying to avoid tariffs and so on. So you don't really see that much in terms of big movements in trade data. I think what's very important, what's very different from the last Cold War are the middle powers, the non-aligned countries, the Indias, the Brazils, the Mexicos. You know, these countries did not have a major role in the last Cold War. They were small, they were not really a big part of global supply chains, but that has changed by a lot. And so what you see now this time around is these middle powers playing the role of connector countries. And we saw that after the 2018-19 tariffs, where while China's direct exports to the US dropped, you saw a lot more of US trade with Vietnam and US trade with Mexico, which were countries that now China was going into in terms of setting up investment. And so you had these lengthening of supply chains. So now I think we're at this point where are we going to see now second and third round of sanctions, which says that, well, Mexico can't trade with China, India can't trade with Russia, and how persistent are those shifts going to be? And I think that's where the big risks lie in terms of some very disorderly decoupling in the world.
In your final months at the IMF, you mentioned this fragmentation that you mentioned. You suggested might have a negative impact on growth. Now, next week the IMF is going to be meeting here in Washington. We'll be live at that, and we are going to be watching very closely what the economic forecasts are going to be for the world in the months and years. And after you take into account all of this recent developments and what that impact on fragmentation, what is your assessment as you look forward? How do you think that's going to impact the growth forecast?
Like you, I'm also looking forward to the numbers that come out next week based on the current tariffs that have been put in place and also the uncertainty surrounding these tariffs. The effect on global growth is, I would say, about 0.5 percentage point, right? We're in that ballpark based on the current levels of tariffs and the uncertainty around it. But what that means for the global growth is, of course, very different, because what we're seeing is, one, that there has been this very long tail of front loading, which is a lot of companies are buying imports from other countries in anticipation of tariffs. Semiconductor chips, for example, flows have increased by a lot, and that is actually boosting a lot of countries' exports. The other T that is quite relevant to this discussion is technology. And technology, and especially AI, is a big tailwind for the world economy right now. And it's not just true for the US, it's also true for France, it's for Germany, it's for South Korea. Any country that's now plugged into the AI ecosystem, either in terms of software development or chips or data centers, is getting that tailwind, and it's really substantial. So if you take out for the US the investment that's happening in AI and AI-related sectors, investment is actually very weak, consistent with the very high uncertainty that we're facing. So we're seeing very interesting dynamics. I would expect that the global economy, in terms of overall numbers, will look not bad compared to what was expected because of this long tail of front loading, because of technology. But at the same time, the projection would be for the global economy to slow.
It was interesting to note that the United States GDP was hugely reliant on this investment in data centers by the large tech players here in the United States. We've got a question here from one of our members I'd like to weave in here now. Over the near term, in Ms. Gopinath's view, is AI going to contribute to growth through productivity, or will it detract from growth by replacing jobs?
I think that's a great question, and I'd say the jury is still out on that. So if you look at the spectrum of estimates of what may happen to productivity from AI, 2 years ago when ChatGPT kind of burst into our collective conscience, there was a whole range of estimates on what that could be, all the way from productivity going up by about 0.1 percentage points, so very pessimistic, to 1.5 percentage points on an annual basis, right? If I look at where people are now in terms of that range, unfortunately, that range hasn't shrunk. There is still that as much uncertainty about where productivity will go. There is a lot of hope. There's certainly a lot of adoption, much faster adoption that's happening of the new technology, but the effect on productivity is still out there. In terms of labor markets too, one thing I do like to remind everybody is that, at least based on the last rounds of automation, you really see the effects of automation on labor markets in recessions. Because when times are good, companies hold on to workers, even if it's the case that what they're getting in terms of the returns from a worker is not that high. They hold on to workers because they're earning high revenues. But when a recession strikes, and you saw this after the great financial crisis, you see a big drop in automation-related job. You have a big increase in automation-related job losses that never come back. And if you remember, we used to spend a lot of time talking about jobless recoveries after the great financial crisis. So I am concerned that in the next recession, which will happen for sure, that we may go through this cycle, even if eventually, like the internet transformed our worlds, this technology can transform our lives too.
I think those risks are something that are on the radar screens of a number of policymakers across the firmament. But I also note that we have a demographic challenge across the world. We have aging, which at my age is a wonderful problem to have, but it does put strains on fiscal budgets when you have a greater number of retirees who are dependent on the tax revenues of a relatively shrinking number of workforce people. In that environment, shouldn't we be deregulating as much as possible and introducing the use of these productivity tools so as to do more with less?
We certainly could use more productivity all around. I mean, there's no doubt about this. And also AI is the most promising technology right now out there that can raise productivity. So that's absolutely wonderful. And we should. I think we're seeing very large amounts of it. And again, I think there is a question we have to ask ourselves is that even if this technology is ultimately as wonderful and delivers all the productivity gains, it can still go through a boom bust cycle. And we saw that with the dot-com and the internet. That's
Right.
what happened. So, there is the long run and there's what can happen in the near term. And I am actually concerned in the near term about the scale of AI investment, what's happening in the stock markets, what's happening with the expectations of what it can do. They seem to me a little frothy.
So you've mentioned the risks of rising public debt around the world, and you have a forecast. I wonder if you could walk us through where you see that headed and what the risks are on that front.
Sure. So global public debt, which as I've talked about previously, is at very, very high levels. Right now, it's about 92% of global GDP and projected to reach 100% of global GDP in 5 years. So that's by 2030. And, to put that in context, at the start of the century in 2000, that number was 65%. So we're basically saying that in 30 years, we expect it to go from 65% of world GDP to 100% of world GDP. That is a very large increase in a relatively short period of time. And if you project even further out, it continues to increase. And there are countries like the US where debt is expected to continue to be increasing over time. So very large amounts of debt. We're no longer in that world post-2010 when central banks were buying large amounts of government debt, or China was out there buying a large amount of international debt. The so-called global savings glut. We don't have that anymore. So we're seeing interest rates go up. They're now basically back to pre-GFC levels. And, given the scale of debt, they actually don't look so bad. But I'd say that the risks surrounding it are quite substantial because pretty much every country in the world hasn't figured out how to align their spending more with the revenues that they collect. If you look at revenues governments collect around the world as a share of GDP, it's just been flat. Expenditures keep going up, and you fill that gap through borrowing. And that is very concerning.
Okay, we have another member question here. How and to what extent can the bank or the fund make up for the U.S. cuts in foreign aid? As you know, there's a fair amount of foreign aid fatigue here in the United States at the moment. And I just wonder, our member would like to know to what extent these multilateral institutions might be able to pick up the slack on that front.
So, the IMF does not provide aid. So it doesn't provide grants. Its main form of lending, it's loans with interest rates on them, right? So there is it's hard to substitute out of this big loss in grant funding that has happened, not just the US cutting back, but including the UK and many other countries in the world. We're all now looking much more at their budgets and deciding to spend more at home as opposed to sending money out. Now, the World Bank can do some more in terms of providing aid. There are obviously non-government organizations. There are the Bill Gates Foundation. They can step in, but this remains an important hit to countries around the world. But at the same time, I should say, just before I left the IMF, I mean, I visited some of these countries, and they are also viewing this. At least some of them are viewing this as an opportunity to move away from relying on international aid. It is costly, though, and of course, it has its consequences.
And your travels, I'm sure you've seen that there are natural disasters. One of our members is asking, will increasing losses from those natural disasters lead to an increased focus on climate mitigation as part of the IMF, the World Bank's day-to-day operations?
Yep. So firstly, the countries in which we are seeing large climate events that lead to big effects on their economy are usually countries where are small. They are not the source of the problem in terms of impacting climate. They're small island nations. So it's adaptation that is the bigger concern as opposed to mitigation. At the IMF, as you may know, the institution has created a resilience and sustainability trust, which is used to lend to countries for climate adaptation and mitigation. And the point is that, especially for countries that now face very large hits to their economic activity because of these kinds of events, the amount of spending that's required at short notice is very high. So how do you plan for this on a fiscal basis? All of this is where the IMF expertise is, and they come in. You may have also heard that there are many who believe that the IMF should not be in this space of climate, and it's going outside its area of what its main mandate is. There is a lot that is very much aligned with the IMF mandate, and I expect that the IMF will contribute to this debate. But I do think that in terms of institution, it's going to be the World Bank that takes the lead on climate.
I'd like to squeeze in one more member question before we wrap up here. Argentina is the IMF's biggest borrower, and it's in trouble again. After so many defaults, shouldn't Buenos Aires just convert its national currency to the dollar? I wonder, this dollarization debate is out there at the moment with the headlines again. I just wonder where you come down on that.
Well, so firstly, to the question of should a country just dollarize. To dollarize, if you want to do this in a way that's not catastrophic, you need dollars. And as we know, there's not enough dollars with the government in Argentina. So that is not a good path. You can always jump off a plane without a parachute, but probably you want a parachute for that. So that's why just doing it without enough of a dollar base is not going to be is just not viable. I also do want to recognize what the gains that have been there in the last 2 years in Argentina, right? So yes, so right now there is significant market turmoil, but let's not forget that this is a country that, under this government, has run fiscal balance for the last couple of years, which is really a new benchmark after a very long time. That has helped anchor inflation expectations. They've also stopped doing monetary financing, which is basically the central bank financing the government. They've stopped doing that. There's been a lot of very important reforms that have happened that are absolutely worth maintaining. Now, of course, as always, this is an incredibly complex case. A lot needs to happen. The political environment is tricky in Argentina, but I really wish the country the very best.
All right, with our final question here, with the IMF annual meetings just days away, I just wonder, what's the one issue you think that leaders aren't paying enough attention to at the moment, the one risk that could define the next year for the global economy?
Well, I don't know if they're not paying attention to it enough, but I do believe that the headline numbers for global growth will probably suggest that the world is fine. And I'm concerned that it's actually more tenuous than what the numbers will be. And just to make sure that, again, the world is holding up together. Trade is holding up because there's a lot of front loading that's happening, because there's a lot of tech related trade that is going on. So trade and technology is is affecting the dynamics of global growth. Right now, it's all holding up, but I think that can change very quickly next year or the year after, and at a time when there's hardly any policy space left for most countries around the world. The fiscal deficits are already very large, debt levels are very large. And so what can you do? What will you be able to do is to step in and help your people when a crisis of this kind happens. So there are many risks, and I suspect that there may be a little bit of a disconnect between the headline number and the underlying risks.
All right, we'll be watching very closely to see how that all plays out. Gita Gopinath, economics professor at Harvard University and former first deputy managing director at the IMF. Thank you so much for joining us today. These really revelatory comments, and I'm sure our members appreciated it.
Thank you, Jay.
Our audience has gotten their shot of informational espresso and is ready to tackle the day. If you've missed a live episode, catch the replay on our website, LinkedIn, or on YouTube. You can also listen to the Calls a podcast edition on Apple, Spotify, or wherever you get your podcasts. Thank you to our members for joining us. This has been The Call, brought to you by the Global Intelligence Desk, asking the right questions to navigate uncertain times.